Taimur Baig is now with us, Managing Director and Chief Economist at DBS Group Research. Taimur, good to have you with us here. Thank you for your time. Before we get talking about the US, just a bit about the India sort of story as well as we wrap up in 24 and look ahead into 25. The stock market types all, of course, now believe that maybe some help is needed at the margin, government spending, monetary policy, etc. So, just wanted your latest thoughts on that, Taimur.
I think that if we look at key components of the economy, it doesn't look as bad as the recent sentiment has been, especially with the angst over the latest GDP data. Look at the PMI. We are actually on a good phase of uptick, and this is not just India specific. We're seeing it across the region. All the doom and gloom about tariff and trade restriction notwithstanding, exporters in India and elsewhere in the world are actually seeing a pretty good order book. Global demand momentum is decent. All the bad news from Europe, uncertainties about the US notwithstanding, demand is good. So on the external side, I see a very nice setting right now. We still have stable commodity prices, which keeps import demand down. We have strong export demand, which keeps export demand up. So trade balances are going to be favorable. So starting with that, looking at the rest of the economy, surely we've seen a bit of a loss of momentum, but is it a function of the fact that real interest rates are too high? I don't think so. Is it a function that there's been a negative fiscal impulse which is draining from support for the economy? Not really. And hence the clamor for more monetary or fiscal support, in my view, is not quite justified. I can understand why. The market watchers certainly want some stimulus, some support to get the creative juices going, creative destruction juices going. But by and large, I think that as far as the RBI is concerned, as far as the Ministry of Finance is concerned, the current fiscal stance, the current monetary stance are just about right. We need to sort of put the inflation genie firmly back in the bottle. Core inflation under control, but headline not quite so. I think it's okay to keep stance as is for the time being.
Taimur, yesterday, and I'm just using that as a sort of, connecting point. China put targets of GDP at 5%, right? It's a $19 trillion economy, and they're saying we'll grow at 5%. We're 3.5%, and we're in the 5% handle now. I mean, we got no business to slow down at this stage, right? For growth journey, a growth journey. I mean, so and if you talk about whether it's are there any large, big reforms which are still left, which can unleash a sort of growth potential, etc. I don't know. I mean, a lot has been done recently, maybe one or two more things. So just come in on that point. And the worry is that are we kind of falling back to sort of that quarter, the before COVID started, right? Growth had already slowed down before COVID hit. And are we going back to those levels? Q3, by the way, in all indications, that's October to December, some of the high frequency data that we're getting is once again not turning out to be all that great. Go on.
Right. So, like I said, on the Q3 data, on the fiscal year side and calendar year fourth quarter data, in my view, is actually not that bad, particularly when we talk about external facing indicators like exports and PMI related to that. I think that aspirationally, of course, India should be growing way more than 5%, 6%. It should be in the 6, 7, and sometimes when the stars are aligned, should be 7, 8%. No question about that. There are times when the global economy hits soft patches. It can be country-specific factors. In the case of India, I would like to think that some seasonality, some bad weather, some agriculture slowdown, some of the cost of living issues have come into play to crimp consumption demand. And I think even the last time I came on your show, we talked about the two-tiered economy, that one part of the economy, tremendous wealth creation, strong consumption, another part of the economy, largely rural-facing, not that great in dynamism. So I think that observation alone can point toward the direction of policy. More support for the rural economy, better infrastructure, better job creation, better opportunities, which probably will not be as headline grabbing as opening a new port or a new bridge, but still very important because that's where a large of the part of the population reside, and that's where the biggest struggle with cost of living is. I think the China comparison is apt. Where is China's growth momentum coming from, given the mountain of debt that they have and the property market crisis and the relentless pushback from the US on trade and tariff front? I think China's secret sauce right now is the fact that at the central government level, there is not a lot of leverage, and therefore there's room to pump prime the economy, even if corporate and household balance sheets are stretched. Secondly, there's a lot of external savings. Large, persistent current account surpluses year after year for decades has allowed China to have a lot of external assets, which it can act as a buffer to support the economy when there's an external headwind. India is on the cusp of building those buffers. The central bank has bigger reserves than anything was imaginable a few years ago. I think that is a good starting point to think about India's financial wherewithal. The fact that Indian companies with strong earnings are again building up strong balance sheet, again, is a very good indicator for the medium-term vitality of the economy. Cyclical patches, sometimes soft, sometimes strong, but overall the economy is going the right direction. I'm sure about that.
Taimur, precariously close to the 85 handle now for the Indian rupee, 84.92 as we close yesterday. What's the outlook on the currency next year?
So for the first quarter of next year, we do see it going past 85 and heading toward 85 and a half, if not 86. But that is very little to do with India. It's all about the dollar exceptionalism and the market basically pricing in tariffs and restriction from the US, which make all the other currencies in the world want to sell off against the US dollar. So this is not an India-specific phenomenon. You look at the region, everywhere we see against the dollar substantial weakness. I don't think FX investors are looking at India separately from the EMFX complex. Going into January 20, I don't think we can fight this. You just cannot fight the dollar at times like this. After January 20, when actual reality of policymaking sets in as far as the White House is concerned, I think there'll be significant differentiation in the FX spectrum, where countries like India, which have very strong external momentum, will outperform on the currency side than other countries where vulnerability to the US is substantially greater.
Hi, Taimur. Good morning and good to see you. And as always, Taimur, let's talk about the next big trigger that we'll get in the next 24 hours. Do you think the Fed has to go with a 25 basis rate cut? And I think earlier you were leaning towards 50 basis points cut from the Fed in the first half of 2025. Sticking to that?
Yeah, but not looking very good, that call. Look, the Fed should not be cutting tomorrow, but they will. They have pinned themselves into a corner. They should not have cut by 50 basis points in September. They did it. In hindsight, looks like the economy really didn't lose its momentum. Labor market is still pretty strong. Inflation has bottomed out. Why on earth would you want to cut rates at a time like this? But the Fed has given such strong forward guidance, they will go ahead and cut. 100 basis points rate cut for the fourth quarter of 2024, a parting Christmas gift from Jay Powell for those who are looking into the holidays. Coming into 2025, and that's where the statement of the Fed and the various forecasts that its members would share with us overnight become important. For 2025, are we now becoming a little more cagey about further disinflation? And if we don't see any further disinflation and see no landing at all as far as the economy is concerned, how do you then justify rate cuts, especially when you know that the Trump administration is strong on cutting taxes and doing tariffs? All of those things could well be inflationary. So that 50 basis points of rate cut forecast that we have for the first quarter of 2025, I am a bit unsure about. Got to look at it during the holidays. I think the January rate cut probably has to be taken out. I think the Fed, in its wisdom, would choose to wait and see what the Trump administration does. There's no upside to cutting rates in January. So I think that call probably will have to scale back. But for the remainder of the year, if the Fed is scared of Trump, and there are times when you should be scared of that big boss, then maybe they'll keep cutting. We'll have to wait and see.
All right. Well, absolutely. We'll see. Taimur, thank you very much for joining us. It's always a pleasure having you with us here on CNBC TV 18.